I look forward to an exciting panel following the lead of Jeff and Ron. So what they point out is that three issues with the corporations in today's world: the increasing complexity, the reconcentration of share ownership, and a growing concern that the markets or the market mechanism might induce potential myopia among the management. So we are going to discuss whether borrowing certain format or functionality of the boards from the private equity finance firms could solve some of the issues that's prevalent in the publicly traded firms. And we are going to have a mix of panelists who are prominent scholars, who are business leaders, and some of whom are actually bilingual in the two worlds. So let me start with a very brief introduction of the five panelists that's present today. Starting with Professor Victoria Ivashina, who is the Leavitt Learned Chair Professor of Finance at Harvard Business School and a research associate at the National Bureau of Economic Research, a visiting scholar at the various central banks, including the Federal Reserve and the European Central Bank. She held several editorial positions at leading finance journals, and more important to this panel, Professor Ivashina co-heads the Harvard Business School's Private Equity Initiative. Then we come to Ray Cameron, who's a managing director and head of BlackRock's investment stewardship for Americas region, and he's based in New York. In this role, Ray leads the team of specialists on engagement, especially in proxy voting activities in the companies that BlackRock invests on its behalf of its clients. And Ray earned his Master MBA degree from Southern Methodist University, Dallas, and also his bachelor degree from UT Austin. And then we come to Professor Elizabeth Berfontenay, who has been on the Duke Law faculty since 2013. Her primary research interest in the field of corporate law, corporate finance, and she teaches a variety of courses, especially covering private equity and hedge funds. She also has done extensive work, especially related to the ongoing decline of the US public companies and the increasing rise of economic activities in the private space. She received her bachelor degree from Princeton University and JD from Harvard Law School. So we also have Christina McGuire, who is a managing director from BNY Mellon's investment management proxy research team. And she oversees the policy voting engagement of a $2 trillion asset at over 12,000 issuers on behalf of the firm's clients. And previously, she held a similar role at Fidelity Investment Proxy Research. And she held a BA degree in communications from UMass Amherst. So finally, we have Professor Simon Whitney. He is both a private equity lawyer practicing law in a London law firm, but also a visiting professor at London School of Business, where he teaches a course on private equity and venture capital law. He recently published a book called Corporate Governance Responsible Investment in Private Equity that was published earlier this year. Congratulations, Professor Whitney. So after the introduction, I'd like to first to go through our panelists and let them highlight their views in a very pointed way on this issue. So I will start with Professor Victoria Ivashina because she co-heads the Harvard Business School Private Equity Initiative. So given your role, so I suppose Professor Ivashina, you probably hold a positive view at very least from along some dimension to some extent about the positive roles that private equity can play or contribute to the financial markets. So I'm very curious to learn what's your view about what if we take from some aspect of private equity portfolio firm, the board format into the public space. What do you think, to what extent and what limitations we need to be aware? So I hope that each panelist could express your view in about 8 minutes, and then we will have some cross questioning. So the floor is yours, Professor Ivashina.
Thank you, Wei. So first of all, it's a pleasure to be part of this panel. It's a really important topic and a thought-provoking set of ideas. So as a panelist, I was tasked with kind of thinking about an exact incarnation of this board 3.0, and specifically what can we learn from private equity. So since we are talking about the public space, let's be very specific in that we are talking about the buyout counterparty to private equity, right? Because they do, if you think across different private equity strategies, they do different things, and this is important to us because they inform themselves in a different way, right? Because one of the core points here is not being thinly informed. So the private equity model is being used here as this empowered director or empowered agent, right? So focusing on the buyout industry, on the positive side, we can take out, of course, buyout deals tend to be control deals, right? And so that can start clouding our mind immediately because we need somebody who is a partial stakeholder here. So in that sense, the recent examples of PIPEs, private investment in public equity, are very helpful in providing us many examples where the buyout industry, I mean, at that point, the name is not matching exactly to the transaction, but nevertheless, they still continue doing what they normally do. So they are value add, but yet they hold a minority stake in a public company. So I think that right there we can say, okay, control is not required, which is great. So we can continue tracing parallels. However, to me, the obstacle here, and look, I mean, it's not an obstacle in the sense that this invalidates a set of ideas, but it just points to us that maybe we don't have immediate off-the-shelf tools that we can just kind of grab from private equity and carry them into the public space. So the major point of obstacle is how the private equity gets informed, and relatedly, at what cost, right? So if we think about what is it that the buyout firms do, so they in the modern and the mature industry, the mature private equity, so let's leave aside the 80s, perhaps even the early 90s, the primary focus of the investments is on operational improvements. More specifically, if we look at the set of transactions in the buyout space, we can roughly, the bulk of them will have either a turnaround or some consolidation, industry consolidation components. So this roll-ups or consolidation and turnarounds are often at the heart of the operational improvements. And there are several other things that are going on, but the point being that they have an active strategy when they invest. So it's their strategy, it's their execution. And so they are not the agents that learn things about the management. Management is, of course, very often important, but it's a partnership. But they are the ones who bring this to the company, and of course it evolves through the process as this is executed. But that's the source of information for the private equity model. And again, it's kind of cornered in the set of companies that are looking for a turnaround, or companies that are there in the industries that are going through the consolidation wave. Distress is another example. And so with that in mind, I'm wondering if private equity at that point is a good example of thinking about an agent that is properly informed. The silver lining of that proposition, however, is that the cost probably will be lower, right? Because we are no longer requiring an agent that will be bringing a strategy and being able and skills to be able to execute on a turnaround or consolidation. And so it's let's not forget that private equity is very expensive, and so we're trying to. So it's likely that what we think about in this context will be something that will be cheaper, but still there is, of course, this being invested on the informational front is intrinsically tied to the cost, right? And it's important for us to understand how big is that cost of that informed agent. And I don't think that private equity gives us a big insight into that, unfortunately. I think it gives us a far removed upper as a ceiling on that cost, but not the actual cost. Now, the final thought here is another thing that we can learn from private equity actually is the fact that, so take a pipe, a pipe investment, which is a minority investment by buyout in a public company. It is incredibly unlikely, and I cannot think of an example indeed, where an activist investor would go after this company because there is a stakeholder with a view, a strategy, and deep pockets that is sitting, that is partnering with the management, even if they only have one or two boards on the seat, right? And so, but for a market, for an activist, it's very hard to go after that firm, right? It's not a person, it's an institution, right? And so that role is very credible. And so what I think I'm learning here is that it has to be some institutional setting as opposed to even the most experienced person, because being exposed to this attacks from potential activist investors or market pressure or just the press, it sounds like that would not work to me. So I think that private equity tells us that we should be thinking about something that will be a form of institution as opposed to individual. And so those are my sets of thoughts.
Thank you, Professor. So, Ray, so you're from BlackRock, which is an institution that epitomizes the concentrated ownership that Jeff and Ron talked about. And BlackRock has become increasingly vocal in the direction that companies are doing, from financial performance to sustainability issues, social responsibility issues. So we're very honored that you agreed to participate in this panel. So we'd like to hear your view about how, from your perspective, that you would view this shift of the board 2.0 to board 3.0.
Well, thank you for the opportunity to represent BlackRock, and to my fellow panelists. I'm very interested in hearing your comments and your perspectives as well. I'll jump right in on just a little bit of level setting. BlackRock is an asset manager, and of the assets that we have under management, half of those assets are in equities. It's about $9 trillion in total. Half of that is in equities, and of that half, 90% is in index strategies. And it's the index strategy portion that the stewardship team actually represents. So because we don't have an option of walking with our feet, so to speak, as the active portfolio managers do, we are long-term investors, we're permanent investors. And so we take that position as an opportunity to encourage the companies and the managements and the boards to take decisions through a longer-term lens. And I think that that's really important in terms of kind of level setting. One of the things that I wanted to highlight is that, when we engage with companies, and our principal responsibilities are engaging and then voting during the proxy season and over the course of the year as well, but voting, we engage very heavily with companies. Last year, we had over 3,000 engagements with companies. And in those engagements, we have engagement priorities that we focus on, and we look for gaps in those priorities that prompt an engagement with a company. One of those engagement priorities is board effectiveness and board quality. And so when we think about that, we look very deeply at the operations in terms of how the board is comporting itself. So for us, it starts with purpose and the long-term strategy of the organization. So when we think about board oversight, we think about it, what it means in the context of where the company is going in the company's life cycle. And so we try to understand what the capabilities are that are necessary to enable the board to articulate the long-term strategy of the organization, as well as to understand and to articulate its capital management strategy. So in short, how the board is fit for purpose of the organization in terms of where the company is today and also where it's going with respect to its long-term plan. The board has to evolve. That is a fact. We are living in a very interesting time in terms of transparency, the pace of technology change, the global footprint that most companies have and the impact of that. The short version is that this dynamic environment that companies operate in is not only raises the bar in terms of expectations of the management of the organization, but also the board as well. So we view the board as really being a potential competitive advantage of the corporation. We look for it to think about how it fulfills its fiduciary responsibilities and its oversight responsibilities. And so when you think about the context of where a company is, its long-term plan, the board's role of providing oversight, it's really important for the board to have the skills, the capabilities, and the capacity to provide that oversight in a very dynamic way to the management team. And so to answer the first question, I think that was kind of posed, and that is, are boards kind of living up to their purpose, or is the 2.0 version kind of outlived? I think the reality is we live in a dynamic world, and boards are not exempt from that, and they are continuing to evolve as well. The effectiveness of boards is really essential in helping companies pursue their long-term strategy. Shareholders, in fact, like BlackRock, are demanding that companies exercise leadership on a broader range of issues, and that starts in the boardroom in terms of the leadership that's provided there. We expect a clear understanding of how boards instill the company's purpose, which drives the strategy of an organization and informs its long-term strategy. In our engagement with boards and with companies, we want to understand how the board assures itself that what's being represented in the boardroom by the management team is in fact what is happening on a day-to-day basis within the organization, not only from a purpose perspective, but also in terms of a culture one. High quality boards, as I said, are a competitive advantage in our view. And some of the questions that we want to understand is, how does the board determine the skills and the experiences that are needed to guide the company to achieve its long-term strategy? Where there are gaps, how they are thinking about filling those gaps. One of the examples that comes to mind is that we had an engagement with a company. There's a publishing company, and they were very excited about transitioning to a digital strategy. This was a plan that was presented by the management team. So we turned to the board and asked them what experience was on the board to provide oversight of the transition to that digital strategy. There was none. And so in our view, and we expressed this to the board at the time, that could represent a failure in terms of governance, right? You're signing on to a strategy by the management team, but not having the required expertise on the board to provide oversight. We think that's critically important. I think boards should evolve to meet the financial needs of the organization as well. I said that's a yes. A couple of the other questions in terms of borrowings that we can learn from the private equity model. I think that there are some lessons that can be learned. I'm not sure that that a full importation is useful or feasible or practical, particularly because in the private equity world, as I think has been articulated, the incentive structure there is incredibly different. We've talked about that, and incentives play a very, very important role in terms of how private equity firms and those agents of private equity firms comport themselves. So I'll conclude my remarks because I know we're running a little bit over. I wanted to provide a little bit of a practical lens, but one of the things that I wanted to say is, why don't we just hold the 2.0 directors more accountable? Why don't we as investors, and why don't we as asset owners and asset managers and investment community hold those directors to a higher level of accountability and demand that they fulfill their responsibilities, or exercise our vote against them? It may not be surprising to most of the panelists and most of the people on this call that most board directors, they received on average 95% approval. So that suggests that, broadly speaking, that at least in terms of their eyes, they're fulfilling their responsibilities. So if we more proactively exercise our responsibility as asset managers to hold those directors accountable and vote against them where they're failing to meet their responsibilities and fulfill their obligations, maybe that's the lever that we need to really start to affect change. BlackRock is doing this. Last year, we voted against over 5,000 directors. And it's not that we do that lightly, but we do the work to understand the responsibilities of the directors and where they're falling short. And our engagements allow us to have, kind of enriched or enhanced conversations, so we really understand, where there may be some gaps. So I just wanted to highlight that maybe part of the solution here is investors holding directors more accountable, and maybe you start to see some movement that average 95% approval rating or support rating starts to drop.
Thank you, Ray. So, Professor Fontenay, so I have read much of your research work, and it's super interesting because you have been doing work precisely on this issue of public versus private financial markets. And we actually have also seen, the border has become more fluid from many different directions. So it's wonderful that we have this opportunity for you to chime in on this important and evolving issue.
Thank you so much, Wei. I'm delighted to comment on Ron and Jeff's incredibly bold and terrific proposal, but I'm going to try very hard to put on my skeptic's hat here. I think, like Victoria and Ray, I'm questioning whether private equity is the right analogy here for the Board 3.0 proposal. So I'm very much in favor of board experimentation, and I have no objection whatsoever to paying directors significantly more than they're already paid. But the proposal raises primarily two questions for me. The first is, would a Board 3.0 work like a private equity portfolio company board? And I think my answer is likely not. So corporate governance is entwined with all kinds of other things in the firm's ecosystem. So the effectiveness, and frankly, I associate that proposition a lot with Ron and Jeff. So the effectiveness of any particular corporate governance regime, including board structure and composition, is inextricably tied to the firm's capital structure, the liquidity and trading of its securities, and background regulation, and so on and so on. And each of those is clearly dramatically different for a private equity portfolio company that is a private company with essentially a single shareholder versus a public company with likely no controlling shareholder. Public companies are just different in so many ways that are relevant to corporate governance. They have many shareholders with competing interests. So one need only look at the ESG debate to see what happens with public company boards and the pressure they're under. We have the big institutional investors asking for totally different things, sometimes conflicting things at the exact same time. That is not a problem for private equity portfolio companies. They have only themselves to worry about. Public companies are subject to disclosure. The private equity board can be nimble and do whatever it wants, whenever it wants. The public company has to worry about information going to competitors, to employees, to regulators. Public company board members are subject to significantly greater risk of liability, or at least involvement in litigation, which naturally would tend to make them significantly more risk averse. And finally, they get instantaneous feedback, whether good or bad, from continuous stock prices. And so I don't think we can expect to just simply port the private equity board structure into public companies and expect it to work the same way. In fact, I think it wouldn't. So I'm worried that the proposal here likely overestimates the power of the board, and in particular of individual directors, versus the entire corporate governance ecosystem that a firm faces. In terms of analogies, I think, if you really want to push the private equity analogy, the closest would be the pipes, as Victoria suggested, or perhaps public companies where the private equity investor hasn't yet exited entirely. So after the IPO, when they're in a lockup, and so you would look at and want to see whether that board performs better than a regular public company board. And I just don't think we have that evidence of that for now. The second question this raises for me is, even if it did work exactly like a private equity portfolio company board, is that what we would actually want? And so here, I think it's worth revisiting what we know and what we don't know about private equity. In terms of private equity returns, it is certainly true that private equity returns have beaten the market over its 40-year, say, history. But there's lots of evidence that those returns are converging or have converged with just investments in public equities recently. And that's no surprise given the amount of money that is poured into private equity. But more importantly, what do we know about the drivers of private equity returns? Do those come primarily from operational improvements and better strategy, or do they come from financial engineering? I think we have lots of evidence for the latter and relatively little, especially over the last decade, for the former. So we do know, for example, that private equity can improve operations in, say, family-owned businesses, but we don't have evidence that they improve operations in very big companies, which I assume this proposal is targeted at. So we know that private equity are high growth firms because they can't bear a lot of debt. But even targets that are perfectly suited to private equity, like brick and mortar retail, our experience in the last decade, and I say this as someone who's a proponent of private equity, the experience with brick and mortar retail for private equity was a disaster over the last decade, primarily because they imposed so much debt on these companies, they weren't able to pivot to, say, online retail or something else in the way that you might expect. So what is private equity? Where do the returns come from? I think private equity is primarily about putting as much debt in the capital structure as the market will bear, transferring the risk of that debt to other stakeholders, such as primarily creditors, but also employees and the government, obtaining that debt more cheaply than comparable companies can. And that is a real advantage. And Victoria has great work on that. And finally, being very good at restructuring that debt if things go wrong. Is that what we want for most public companies? I'm not so sure. There's no suggestion that companies are having a hard time attracting capital right now. And in particular, what's the problem with lots of leverage? Well, we know what the problem with lots of leverage is. It exacerbates both the boom and the bust of boom and bust cycles. So to finish off, for those who are wondering whether we're in an asset bubble, I will just point out that with respect to private equity specifically, currently, almost 80% of US LBOs have leverage of more than 6 times EBITDA. That number was 25% immediately before the financial crisis. So that should pose some worries. And a co-author and I have shown that the definition of EBITDA is so inflated that this likely dramatically underestimates the amount of leverage. Secondly, acquisition multiples are currently at 11.4 times EBITDA, when this was about 9 times immediately before the global financial crisis. So final thought, since I am in theory coming from a law faculty, if the problem is that boards are relying currently too much on independent directors, I think it's worth noting that this is not an organic development. This is a development that is driven by the law. The problem is that Delaware law and federal law have both evolved to offer so many carrots and sticks that push in favor of independent directors that they have kind of artificially inflated the demand for independent directors far beyond what shareholders would actually want. And so I will say something that I almost never say, which is I think here probably the starting point is actually focusing on the regulatory side and not so much on private ordering. And I will stop there.
Thank you, Professor DeFontenay. So, Christina McGrath, you're from BNY Mellon, just like BlackRock. You're from one of the largest asset managers as well as shareholders of the public companies around the world, especially in the US. So, from your view or representing your institution, what do you think are the asset manager or shareholders' demand for what the current boards need to change or need to improve, and how this could be related to private equity model? So Christina, you need to unmute. Thank you.
Sorry about that. Thank you so much for inviting me. I appreciate it today. It's great to see you, Ray. We haven't chatted in a while, but I do want to sort of circle back and not repeat a lot of what Ray said, because similarly, as a large institutional investor, Bank of New York Mellon is responsible for, overseeing these assets and verifying that the board is working in shareholders' best interests. But a couple things that Jeff and Ron said earlier, which was really interesting in sort of looking at those graphs, and it sort of pings off what Elizabeth just said about regulatory, right? And so when we look at that graph and look at, board 2.0 model, we see this shift, right? And part of that shift is, the regulatory environment, but also part of that shift was the Department of Labor, right? The Department of Labor in the late 80s, early 90s put rules around proxy voting that required institutional investors to think, about who was on the board and to vote in a way legally that they could defend. And so we see that shift, right? Not just to independent board members, but the structure of the board changing, the way people are elected are changing, right? And part of that is not just the regulatory environment, but it's all of a sudden you have massive, large institutional investors, right? And so the Fidelities and the BlackRocks and the State Streets of the world start getting larger and larger. And so there's fewer and fewer over time, large institutional investors with those assets compressing and being controlled by fewer, larger institutional investors. And so here we are, right? decades later, and in a situation where you have 10 large institutional investors managing nearly $50 trillion. And so that's a game changer, right? So that's a framework that you guys are talking about sort of at the board level, but it's also being driven fundamentally by shareholders, right, from the bottom up. So that's something I did want to talk about. And then, as that defined benefit sort of to a lesser extent gets much, much smaller, and that defined contribution sort of influx of dollars gets larger over time, that really changes how we as institutional investors have to think about our role and have to think about the board's role on our behalf, right? And so the board's roles are our seat, there are megaphone, right, at the company. I think one of the things that we think about and sort of we see anecdotally is a little bit about what you guys are talking about, Jeff and Ron, with respect to sort of that private equity model. And so when we look at micro caps and small cap companies, we sort of see this hybrid version of a private equity board model where you have, deeply invested representatives from those organizations, along with some of their peers and their operational expertise that they bring onto the board. And they're working in concert. And we know this because we work really closely with the micro cap and the small cap companies, that there is a tremendous day-to-day influence on those companies. And as those companies get larger in market cap and the private equity folks exit, we see that sort of move to a more traditional version. So I think when we think about the future of this, we think about a couple things. We think first and foremost, cap matters, maturity matters, and having that board structure that you would see for GM or Exxon or Disney today on a company that's market cap is under $1 billion makes virtually no sense, right? And so thinking about how do we transition, because we think it is a growth trajectory, just like your market cap. How do we transition those companies? There are going to be exceptions, right? There are going to be these Ubers that come into the market at, far, far in excess of a mid or a large cap company, right? So those are going to be the exceptions. But when we're thinking about how the growth trajectory of these firms looks and how it's sort of naturally happening today, is that the model that makes sense from that micro to small to maybe mid cap before they hit the large cap structure? One of the other sort of pieces of data that we're getting in looking at these large cap companies, there's been this view in 3.0 that you need to have a variety of expertise. And I think what we're missing today in companies that are more narrowly banded is having a very narrow band of experience. We're asking boards to be all things to all people all the time, and that's just not realistic. You can't have somebody who, is an energy specialist and oversees all the government affairs and is the head of cybersecurity. I mean, it just, it's getting unrealistic to ask boards to manage that scope and scale of information at a large cap company. So I think we do need to completely rethink what a board looks like, why a board operates the way it does, what they're bringing to the table. There are no models today that suggest, outside of the US, what that new version should look like, but it should certainly change over time. And I think one of the other things, we appreciate the fact that a lot of companies want marquee board members, right? They want former CEOs who have had multiple experiences, who understand what catastrophe looks like, who have lived through various catastrophes, who can help a company navigate something like a pandemic, et cetera. However, what we're finding is that they may not be any better suited to do that than maybe folks who have sector-specific knowledge. So I think one of the things we're thinking about is what makes sense. Is it really a board that has an area that focuses in on operational expertise for that sector versus, sort of broad managerial experience? And I think that's part of the new version. And then the other thing is board size. You know, we don't need boards of 14 people at a $500 million market cap company. We also have very, very large US cap companies who have boards of 8 people, which we are quite concerned about being way too thinly staffed and managed to handle that level of scope and responsibility. And as an example, Apple's one of them, right? Apple has 8 board members. How those 8 people can manage that company, which has a very broad scope and scale. I think once upon a time that was not the case, but that is the case today. You know, when we think about JP Morgan Chase that they talked about, the scale and scope of the board has really narrowed down, but the business at JP Morgan Chase hasn't narrowed. So are these situations rife with risk? And that's a lot of what Ray was talking about earlier, right? And so the board represents us. They oversee our risk, right? They're our voice at the company. So we're really looking at what makes sense. Do I think a full-on private equity model would work at a mid or a large cap company? Probably not. I think you're right, Elizabeth. But I think there is something that needs to happen. Just generally speaking, you know, we certainly see what happens when an activist investor comes onto a board, right? We see significant change prototypically in 12 to 24 months. And they're to a certain extent bringing that private equity sort of vision and view to a larger boardroom. So I'll conclude my comments there because I want to make sure everybody else has time. But you know, one of the last things I want to talk about is the board is, and I've said this to Ray before, they're really out of touch with overseeing pay for performance. And what we think is that fundamentally they don't understand the numerics around that. They don't understand the performance outcomes around that. And what we're seeing generally in the market is that boards are ratcheting up compensation at a level where about 40% of US companies are overpaid relative to performance. So that's another area that I think that private equity vision and view would be helpful with respect to the future. Thank you.
Thank you, Christina. You're right on time. Professor Whitney, you stride over both academia and practice, and you have heard the other 4 panelists' views. I very much would like to give you the last words on the panel to see what you think.
Thank you very much, Wayne. Thanks to Jeff and John for inviting me to participate in this really excellent conference. And I must say, I really like the idea of looking at the way private equity firms bring additional resource to their boards of directors. But I also agree with many of the comments made by other panelists. In particular, I agree that we really need to focus on the incentives of the people sitting around the board table. In the research I undertook for my book, I looked at the way that corporate governance is organized in 50 UK-based private equity-backed companies, many of them in the mid-market. I looked at the size and composition of the boards. I looked at the authority of the board. I looked at the way that decisions are taken. And in my book, I argue that these corporate governance systems, boards usually being at the center of that system, I argue that they actually have multiple functions. One of those functions, the one we're probably focusing most today, is that the board has a laser-like focus on making good decisions and in overseeing the management of the company, but also in partnering with them in making the key strategic and operational decisions of the company. And that's a very important feature of the model. And I think there are many features of the private equity board that make them well suited to this function. They tend to be small. In my sample, the average board was between 6 and 7 people. Interviews arguing that somewhere between 5 and 7 were optimal sizes for boards. To Christina's point, that probably reflects the relatively smaller scale of the businesses I was looking at, but people arguing that smaller groups, not too small, but smaller groups are better at making decisions. Everyone around the board table knew the company extremely well. They knew the dynamics of the business. They knew the dynamics of the sector. And they had high-powered incentives to increase the value of the business during the period of ownership, looking forward to an exit valuation. Exit valuation, of course, driven by future prospects for the business at the time of exit. So thickly informed and thickly incentivized. Certainly regular board meetings, usually 10 or so a year, ad hoc meetings, many more ad hoc meetings in between to deal with specific issues, and considerable power for the taking charge, not just of strategy and budgeting, but also operational decision making. So an central role for the board. In most cases, the board also took close responsibility for downside risks. That's an increasing trend. It's certainly the case that boards are focusing more in the private equity sector on downside risks, including ESG type downside risks. And interestingly, in 75% of the companies in my sample, there was an external non-executive chair brought in, usually brought in because they have some particular industry or sector knowledge that was felt to be missing, thought to add to the board's skill set in a meaningful way. So again, with the objective of helping the board to make well-informed decisions, having more resource around the board table, not the same role as the one that that Ron was describing for the public company chairman as part of his presentation on Board 2.0. So yeah, I certainly agree that one of the functions of the private equity board, and one they're well equipped to undertake, is to make good decisions and to oversee the management team, but making good business decisions and making sure that there's a mechanism to hold management to account in intelligent ways, of course, the function of most boards. I think actually what's important for us in this discussion is to think about not just how decisions are taken, but in whose interests those decisions are being taken, and with what objective and over what time frame. In my view, the answer to that question is that private equity boards are well equipped and incentivized to make decisions that further long-term shareholder value. Long-term shareholder value. Now, some people raise eyebrows when I refer to private equity investors as long-term. I haven't got time now to go into why I think that's the case. But of course, most investors, BlackRock and Bank of New York Mellon among them, and certainly most policymakers are really focused on getting companies to look at long-term prospects for the business, long-term risks, and to have a long-term plan. And public companies are often berated for not doing that effectively. So that's one of the problems I think many people would say we need to fix. And it seems to me that the exit mechanism, the focus on exit value, is a way in which private equity boards get to focus on long-term value. But I think it raises a challenge for porting these over to the public company model, which is how do we persuade investors and regulators that Board 3.0, with these thickly informed additional resources, are focused on long-term outcomes, because I think that is an important problem that people want to fix. And I think we have to be thinking about how Board 3.0 can fulfill that role. And I think the second challenge is that although policymakers want to focus on long-term, it's much less fashionable for them to talk about wanting companies to focus on shareholder value. Certainly it is here in Europe. Stakeholder value, pursuit of purpose, these are all politically salient topics. And personally, I'm very skeptical of alternative, potentially competing objectives for a company. Again, we don't have to go into that now. We don't have the time, but I think that we have to understand that in the society we live in, the expectations of businesses are that they will take account of externalities and that they will take account of stakeholder interests. And certainly we all want businesses to focus on those things. So it seems to me that an exclusive focus on shareholder value is not likely to endear any board model to policymakers, and certainly not to policymakers who haven't yet got around to doing what I think they should be doing better, which is internalizing the externalities so that the companies really have to focus on them. In Europe, private companies are facing increasingly more reporting and disclosure obligations. They're beginning to look more like public company boards in the way that corporate governance codes and other reporting obligations are imposed on them. And that's all because society understands that corporate governance isn't just about looking after shareholders. It's about thinking about how companies, how businesses have regard to their societal responsibilities. And so I think, again, actually private equity has a redeeming feature in this regard. And again, I haven't got time to go into it, but in my book, I talk about how the objectives of the private equity firm and its own investors and the transmission mechanism that it has between its ultimate, pension fund investors and the board of the underlying company transmit some of these increasing, focuses on ESG, sustainability, diversity and inclusion, and so on, down to the underlying board. That certainly doesn't happen perfectly, but I think it's one way in which we might expect private equity-backed companies to behave more responsibly. But again, if we're thinking about evolving the public company board, then I think we also have to think about how we persuade certainly policymakers, certainly here in Europe, that a board which is incentivized to focus on shareholder value can really fulfill their social value function. I mean, demonstrating how companies fulfill their social value function is going to be critical in the years ahead, and boards obviously have an important role, a vital role to play in that. So I think even if a focus on shareholder value, a laser-like focus on shareholder value, is a good way to create efficient companies, we also have to have an eye to the other objectives of both investors and regulators in thinking about how public company boards might evolve. Thank you.
Thank you, Professor Whitney. So Ron and Jeff, would you like to take a minute or two to respond, or you want to respond at the end of the second panel?
We could respond now. I have a couple quick thoughts. First, let me just pick up a theme that I think Ron developed, which is that part of the point is not just to say that PE governance strategy is the only board 3.0 variant that might well be considered, but that given the issues that board 2.0 does not successfully resolve, we should be open to creative alternatives about thinking about the board. And that's in a way that the evolutionary model doesn't necessarily have an endpoint. Private equity is going to be the creature that emerges from the sea and controls over all of us. But the point is to have an environment in which experimentation is welcomed as opposed to snuffed out. On PE specifically, the argument is not to import the financing strategy of the PE model, which is leverage, et cetera, but rather the PE model of governance, which is to say to have the board be one that is expected to be deeply informed about the firm and to be committed to the firm in a way that the part-time director model is not, and to have sufficient incentives to do those first two things. So it's not necessarily that we bring with it the leverage structure of the PE model. It's rather conditional on the way the firm's going to function. It's having directors that take a deeper view of their role than the current model of directors. More to be said about that. This third point I want to make is that the panel at some level has not been fair to the failure of the 2.0 model to address a fundamental issue that we now see, which is that the claim is that the activist pressure on firms leads them to engage in short-term decision-making, and that this is a real cost that the current board model simply does not address. And so it can't be that we throw up our hands and say, well, tough. And so the point of having an optional model, which for some firms may work well, of having a particular kind of board 3.0 director of the empowered director style brought over, say, from the PE strategy, will increase value for that firm. Because if you have a director who, unlike the present board, is known to have a deep enough information base, et cetera, to offer a credible shelter for management plans that might be hard for the market to appreciate, hard to explain because you can't reveal facts which would give away the strategy, et cetera, then actually there is an issue which is solved that the present board model hasn't solved. And so it's not just that, in some general way, we would want to change the way directors interact. It's that there are ways in which the present board model is falling short of that which we would want a good board to do. And it's the contradiction there. It's the lack of fit. That's the evolutionary point. It's the lack of fit that impels the desire to look for innovation, not in effect some theoretical framework that boards ought to, be in a different way. And similarly, the JPMC story, the sheer complexity of the business that you're asking the board to oversee does suggest that the present board model that we expect them to apply doesn't seem to be a fit with what we would want a board to have capacity to do. So I'll proceed, and maybe Ron has a few additional points.
Ron, you have to unmute yourself.
Thank you. I'm going to be brief. Let me start by being, I can't quite frame how much I appreciated the panelists' comments. They filled in a broad range and they did it enormously effectively. And Jeff and I learned a great deal. The first thing I learned is that in our presentation, PE, the private equity model, highlights something, but not other things. That is, what we see in the private equity model is one technique in one set of circumstances with one set of companies in certain kinds of markets that accomplish the three things that we actually think of as defining board 3.0. That is thickly informed, thickly resourced, and thickly motivated. How you engineer that is almost tautologically going to be different depending on the company, on the industry, and the like. And I'm going to say one more thing, though. Everybody's comments were really perceptive. I just want to say one thing. The way in which conversation gets skewed by people deciding they don't like short-term and they do like long-term is the conversation killer. The investment horizon of a company, and with respect to an investment, depends on the company and the investment. The notion that we want to skew discussion toward long-term as if the only thing we build our infrastructure at a time in which many major companies pushed by the consultants are moving toward an agility pattern in which they can make decisions faster and quicker because the length of the experience curve is getting shorter and shorter and shorter. So where you end up in this, how General Motors decides that it's going to be a first tier, an OEM supplier with its batteries at the same time that it's making cars, those judgments, those decisions, the length of our investment horizon just depends. And the notion that there's a story in which simply saying we favor the long term, we favor the right term for the particular investment. And the conversation just gets lost in it because we think as long as we characterize something as long term, that's terrific. General Motors was long term. They basically destroyed more jobs than any bad private equity person around. we watch JE disappear over the short term, I could draw a conclusion: never invest in anything that is defined by 2 letters and starts with G. The trick is, can we get a governance structure in which there are thickly informed resources, thickly motivated, and we can find examples of those characteristics from the bricolage of different companies and different industries. So how you engineer it is going to differ across the board, but we're not going to resolve any of our problems, I guess, by long term. Last comment, and this simply goes to the managing a large shareholders row. I see it as the independent share of an asset manager with a whole lot less money than the much bigger folks we've seen. But what puzzles me is I don't recall the last time I've heard of a large investor publicly taking a position, not that we should vote to have more disclosure of one thing or another, but we don't like the kind of people you have on your board, and here's a list of names we want you to think about. We could change that. If I was voting BlackRock shares instead of the $250 million, the little place I play around with, I can change board ownership really damn fast, and it doesn't have to make the papers. But if I don't think there are people, we have the right people, then to rely on the shareholders, they've got to play with sharper elbows, and it continues to puzzle me why they don't. This was a spectacular panel for which I'm very grateful. It's going to take a lot of time to integrate it, and I'm very much appreciative.
Thank you, Ron. So due to the time limit, I have to conclude this panel. So thank you all to the 5 panelists. And I also hope that there will be more time in the next panel in the future to discuss many of the interesting questions, some of which are already in the Q&A board. They point to certain central issues, just like Ron pointed out, how to engineer the new board model. Is it because we're going to select a new type of board members, or are we going to get the current type of board members more thickly informed and more incentivized? I think I look forward to more discussions in the following panel in the future. But let me just conclude here. Thank you, everybody. And I return the chair position to the conference organizer. Thank you.